Hello and welcome to The Business. I'm Elise Morgan. Coming up on the program, thrashed with a feather, how the peak financial planning body protected a banned advisor. And the worrying truth on liar loans, claims the regulator was missing in action over dodgy loans. Those stories coming up, but first, shares in the country's second largest mortgage lender, Westpac, have tumbled today after banking analysts at investment bank UBS suggested it's time to sell. The advice comes after concerns were raised at the Banking Royal Commission about the quality of Westpac's mortgage book. A UBS report released today says documents from the Royal Commission show the banking regulator APRA assessed Westpac as a serious outlier among the four banks. It says more than a third of Westpac's borrowers have debt-to-income ratios of more than 7 times, and almost half of applications showed borrowers would have had less than $250 left after their mortgage payments. Last week, UBS told the business this would lead to lower house prices and could lead to higher unemployment.
To go from a period of easy lending standards to tight lending standards runs the risk of unintended consequences, and that could be the so-called wealth effect, where the drop-off in house prices causes consumers to drop their consumption, and that feeds back to the labour market.
By the end of trade, more than $3.5 billion was wiped off Westpac's value. Shares finished down 3.6%. One prediction out of the flood of revelations on dodgy loans out of the Banking Royal Commission is that the cost of borrowing is going to rise. The founder of LF Economics is Lindsay David, who's been investigating declining lending standards for some time. I spoke to him earlier. Lindsay David, internal documents from Westpac reveal that only 1 out of 10 lending controls required by the regulator are working effectively. How could this possibly happen?
Well, you have to look at the way our banks are regulated. When it comes to the mortgage market, our banks are essentially running a lawless business. There's no real regulatory oversight over how our banks have lent to home buyers, and it's only been now with this Royal Commission and that the banks are actually now starting to have this problem whereby the way they've been lending over the years is coming under scrutiny, and also what's coming under scrutiny is the way our regulators have approached allegations of lending misconduct. So when you've got 9 out of 10 controls in place, 9 out of 10 controls that are not in place, you could rest assured that the banks are going to be lending to home buyers in a way that they're not supposed to, which raises very, very serious questions in terms of what the quality of the mortgage books at our banks actually look like. And if you just talk to a few of the other commentators out there who have shared our opinions, it's pretty clear that I think it's pretty safe to say now that there's a heck of a lot of junk in these mortgage books that are sitting at our big banks.
Would you agree with UBS that this information that's come to light raises questions over $400 billion of Westpac's loan book?
I would say that's a pretty good number to start looking at. Around the $400 to $700 billion range would probably be my better estimate. The big issue we have is the banking system has issued so many interest-only loans, a lot of which don't really appear to have been properly verified and illustrate that the borrower is actually going to be able to pay off that debt over the course of these 30-year loans that are being issued to home buyers. So it is very clear to see when you take a forensic approach into the way banks lend to home buyers, it's very hard to see that it's only a very small sample of loans that are actually never going to be repaid versus a larger sum, and we can start comfortably talking about this $400 to $700 billion figure of loans that are simply never going to be repaid should this, especially should this Sydney and Melbourne housing market start to fall a little more. You just got to look at these mining towns and observe how many borrowers were unable to pay their mortgages. And when you forensically examine a lot of these borrowers who were not able to pay these mortgages, one thing was very clear, that these borrowers just simply shouldn't have been given a loan in the first place. And then when you start looking at the forensic documentation that showed how these banks were able to get these loans across the line, it's very hard to believe that criminal activity or illegal lending in the Australian mortgage market is not systemic.
So what's happening here? Is it that the regulators, be it ASIC and APRA, aren't delving in and looking at the documentation and doing proper forensic oversight of what's going on? Or is it that they're being lied to, do you think?
Well, in our forensic research, we've spoken to consumer advocates such as the BFCSA and a lot of the alleged victims that they represent of mortgage control fraud. And when you start to look at their documentation alongside the documentation that we've been given to by other aggrieved borrowers, it's pretty clear. The big question we always ask them is, what was the response from ASIC or APRA when you went to make the allegation that your lender had fraudulently tampered with your financial circumstances to make you look more creditworthy than what they really are? And on every single occasion, what we understood was ASIC and APRA both refused to investigate the matter on an individual basis and on a systemic basis.
Lindsay, David, thank you so much for your time.
My pleasure.
And the shocking revelations keep coming from the Royal Commission. Financial planners were back in the dock today facing allegations of protecting their own. One industry association didn't expel a banned advisor, while the other admitted to protecting the identities of wrongdoers. It also proved to be a day of high drama, with the final witness collapsing while on the stand. Daniel Ziffer was there.
When a client complained about bad advice from Sam Henderson, the celebrity financial planner didn't hold back. Calls and emails from Henderson to the investigator, the investigator's boss, and finally the CEO of Financial Planning Australia were tendered to the Royal Commission.
It's precisely the problem, Mr de Gory, the subject of the complaint having these direct discussions with those who are investigating him.
As the investigation unfolded, the high-profile member appeared to threaten the head of the member body. My peers would be interested in the workings of this process, he wrote in an email, and what it means to be a member of the FPA. Shortly after, the body agreed to lower sanctions and to keep Henderson's name suppressed.
So the FPA offered to keep Mr Henderson's name confidential.
I'm not aware as to how that particular component got into the final terms.
There was more. In a letter, the organisation's head of professionalism begged the Royal Commission to not identify Sam Henderson, because doing so would cause significant damage to his reputation.
How is it possible to hold members accountable for their misconduct if their identity is kept confidential?
The complaints process at rival body, the Association of Financial Advisors, isn't any stronger. A planner, banned by ASIC from providing advice for 5 years, remained a member because the regulator's report was likened to hearsay. Dover Financial's Terry McMaster copped sustained questioning about his complex web of companies and about policies that shielded him from customer complaints.
It is Orwellian to describe this as a client protection policy.
I agree with that.
It is entirely misleading,
changed.
Yeah. Entirely misleading to call this a client protection policy.
It actually wasn't intended to be misleading. It sort of evolved.
Towards the end of the day's hearings, he collapsed in the witness box and was taken away in an ambulance. Federal Treasurer Scott Morrison today said he was prepared to extend the Royal Commission, due to report in September, but hasn't been asked.